In this video, we're going to talk about budgeting. This is chapter 10, Strategy in the Master Budget. When we talk about a master budget, we're talking about the group of all the budgets put together. That's just the master budget, or a compilation of all the budgets. And when we have budgets, they can generally be broken down into two areas. There are production budgets, or operations budgets, and there are financial budgets. And we generally have to start with some of the production budgets in order to move into the financial budgets. In fact, we always start with the sales forecast, or the sales budget. If we're thinking about manufacturing, why would we manufacture something if we don't intend to sell it? Obviously, a little bit for inventory, but the idea is we have this sales budget. From the sales budget, we can develop what's the small letter production budget, which is how many we're going to produce. This will include how many we already have in inventory or expect to have in inventory, and how many we want for the future inventory going forward. From the production budget, we can then do the materials purchases budget. The labor budget, and the manufacturing overhead budget. All right, so that will give us all of our information. From that, we will create a financial budget, and that is the cost of goods manufactured budget. From the materials and the purchases budget, we will also create a cash disbursements budget. From the sales forecast, in addition to the production budget, we will also produce a cash collections budget. These two, the cash collections budget and the cash disbursements budget, gives us basically a budgeted cash flow statement. Lots of times we just use a budgeted bank balance statement, cash flow, bank balance. We can do the budgeted income statement. But before we do the budgeted income statement, we need to come over here and do the selling and administrative budget. Then we can go into the budgeted income statement and the budgeted balance sheet. That's the basic order that these are done in. Sometimes they can be done a little bit out of order, but you're obviously going to have your materials purchases budget, your labor budget, and your manufacturing budget in order to get the cost of goods manufactured. You're also going to need these for the cash disbursement, so those are going to have to come first. You're going to have the production budget before you can do any of these three and you have to have the sales forecast. So that's basically the order that we do these budgets in. And obviously, as I mentioned in one of the prior videos, the budget is the responsibility of management. Obviously, the accounting departments usually help a great deal in that. But the accountants are not responsible for what's the sales forecast. That has to be management and the marketing department and that group of people. And what's the inventory policy going to be, which is necessary to know for our production budget. We'll talk about that as we go through some of the problems. So let's look at some problems. I've chosen exercises because that is the level of difficulty you will see on your exam. And honestly, if you know how to do what's in the exercises, then what's in the problems are just compilations. If you look at the problems, one of those problems is just too long to include on an exam. It would be entirely feasible to take an hour and a half to do one of those problems in your textbook. They're good problems, they're excellent problems, but if you get these basics down that are in the exercises, you'll be able to combine those into the whole and get that accomplished. All right, so the first exercise we're going to look at I have is 10-25, production materials purchases budget. So White Corporation's budget calls for the following sales for the next year. So we've got a whole, this is in quarters. So Q1, Q2, Q3, and I like to stack them this way. Your book has a slightly different presentation for the information, but I like to take the information this way, and you'll see why in just a minute. And the Q1 is 90,000 units. Q2 is 76,000 units. Q3 is 68,000 units. And Q4 is once again 96,000 units. Now, let me explain the first thing about this budget. When you're doing, this is your sales forecast. This is what you're projecting to sell during the year. It doesn't matter what time period you're using, whether it's months, weeks, quarters, whatever it is. Your sales forecast must extend out 2 periods beyond what you're actually forecasting in order to get the materials purchase budget. So on the production budget, we will lose 1 period, and then on the materials purchases budget, we will lose a second period. So this is just our sales, and that's given to us, right? We didn't have to make that up. That's just a given to us. Okay, so if we go down in the narrative, it says each unit of product requires 3 pounds of materials. We'll need that for the materials purchases budget. The company's policy is to begin each quarter with an inventory of product equal to 5% of that quarter's estimated sales requirements and an inventory of direct materials equal to 20% of that quarter's estimated direct materials. And then the question calls for us to determine the production and materials purchases budget for the second quarter. I'm going to expand that just a little bit and show you how to do the whole thing. We will get the second quarter out of that. But part of the reason is that we don't. So we have to have the ending inventory. And that we're told that's 5% So remember the ending inventory, this quarter's ending inventory is next quarter's beginning inventory, right? So we want 5% of this 76,000. So we need 3,800 units for the beginning inventory. Now, this problem doesn't tell us, and since we're not working with when they're not asking us quarter two, it's not really necessary. But I'm going to imagine that the 5% for quarter one was met, and so that's going to be 90,000. Whoops. So we would have 45 in beginning inventory. Whoops, 4,500 in beginning inventory. Okay, so we have to make what's going to be in ending inventory, but we don't have to make what was already in the beginning inventory. So this becomes a subtraction, right? Now you can shortcut that and say I need to make, in this case, 700 less than here. So I can just automatically say 89,300. If I sum those up, I get 89,300. Okay, so I just do this all the way across. So 5% of 68,000, I get 3,400, but I'm going to already have, remember, this quarter one's ending inventory is quarter two's beginning inventory. So I will subtract the 3,800 here, right? And so now I'll need 400 less than 76,000. So that will be 75,600 in that one. And then finally, I'll need 5% of 96,000. So that's 4,800. And I know I have 3,400. So in the beginning inventory, just move that down. So I need to make 1,400 more this time, right? In order to ramp up for quarter four. And so that's going to be 69,400 that I'll need to make. As you can see, this is why this is our production budget, and I lose a quarter here because I don't know what I'm going to sell here, right? So I lose a quarter, or I lose a time period. And so you always have to go out 2 time periods, as you'll see. So the question called for the production budget for quarter two, so that's it. I need 75,600 on that. And then it calls for the materials purchases budget. So the way to get to the materials purchases budget, you'll remember in the narrative we read that each unit of product requires 3 pounds of direct materials. So I multiply each of these by 3. So I need 208,200 pounds. That's just to make, or that's the materials needed to make that. We haven't talked about inventory yet. Right, and then quarter two, which is the quarter we're focusing on, I need 226 pounds, 800 pounds of materials to manufacture that. And then in quarter one, I need 267,900. Getting ahead of myself there. All right, so this is what I need to make, right? But we haven't talked anything about inventory. Going back to our narrative, direct materials equal to 20% of that quarter's estimated materials requirement. So in this case, I'm going to take the 20%. That's going to be in the beginning inventory. So 20%. So I need 45,360 pounds in ending inventory. And again, I'm going to assume, because we're focusing on quarter two, so they didn't give us what we would have in quarter one. Lots of times in a problem like this, they will give you, the company is expected to have X number of pounds in beginning inventory January 1, something like that. So let's say the 267,900, 20%. So that would be 53,580. And we just do exactly like we did before. So that's we just add all of those up and we get 259,680. That's how many pounds we need to buy during quarter one. Okay, so we do the same thing again for quarter two. We go over to quarter three. We need 208,200 times 20%. So we need 41,640 in the ending inventory. Once again, we can bring this beginning inventory down because this is the ending inventory. That's the beginning inventory. And I subtract that off. So I need to buy 223,080 pounds. Now, see, quarter three drops off now because I don't have the quarter four inventory number. So that's why I was saying at the beginning of this problem, you have to have 2 quarters of sales beyond what the period of time you're budgeting for. So that gets us to the materials. Okay, and so this was the one they wanted us, is quarter two. So that would be our answer. We're going to make 75,600 units of these in quarter two. That's what we will produce. And we need to buy 223,080 pounds in quarter two. So that solves this particular problem, 10-25. All right. Let's move on then to 10-26. In 10-26, we've got budgeted cash receipts and cash disbursements. Okay. Kimco, a retailer, makes both cash and credit sales, i.e. sales on open account. Information regarding budgeted sales for the last quarter of the year as follows: October, November, December. Our cash sales are given to us of 100,000. I'm just going to copy what they have here. And this is October, November, and December. Okay, then we have credit sales of 100,000, 150,000, and 90,000. And that gives us our total of 200,000. 270,000 and 170,000. All right. Past experience shows that 5% of credit sales are uncollectible. Of the credit sales that are collectible, 60% are collected in the month of sale, and the remaining 40% are collected in the month following sale. Customers are granted a 1.5% discount for payment within 10 days of billing. Approximately 75% of collectible credit sales take advantage of the cash discount. Inventory purchases each month are 100% of the cost of the following month's projected sales. The gross profit rate for Timco is approximately 30%. All merchandise purchases are made on credit, with 25% made in the month of purchase and the remainder paid in the following month. Okay, it says calculate the budgeted total cash receipts in November and December. All right. So the easiest way I've found to do this is create a matrix. We've got November and we've got December. And here we're going to have October, November, December, and you can put cash in here if you want to do it separately. All right. Okay, so our cash sales in November was 120,000. So we're guaranteed to collect that, right? And in December was 80,000. So we've taken care of that, of those two right now. All right. So now in October, our credit sales are 100,000. So we come down here to a little piece of scratch paper. We're going to have 100,000. And in credit sales, and we are told that 5% are uncollectible. So one minus 5% would be 0.95 is the amount we're going to collect, or 95,000. That's what we collect. Now, one of the things that confuses students when we do this, because it's different than financial accounting. In financial accounting, we're going to record all 100,000 and then have an allowance for bad debt of 5%. Here, we just take that out, and once we take it out, we just forget about it because we're dealing with the cash, not the financial aspect of it. So we're going to have 95,000, and we are told that approximately 75% of collectible credit sales take advantage of the cash discount. Okay, so we're going to multiply that times 0.75. So that's going to be 71,250. All right. And they get a 1.5% discount. So we're going to take 1.015, multiply that. And that will be 1,068.75. I'm just going to round that to 69. I'm not going to deal with the pennies. You don't have to deal with the pennies. Remember, we're dealing with estimates here. So 25 cents isn't going to, we will be off more than 25 cents because we're dealing with estimates. Okay, so we go back up here to the 95,000. We subtract 1,069. Okay. and we get 93,931. So out of that 100,000 credit sales, we're going to collect 93,931. 5% goes away because it's uncollectible, and 75% of 1.75 of 1.5 goes away because they get the sales discount. All right. So now we go back up here to the narrative, and it says 60% is collected in the month of sale. So we're dealing with October sales now, the 100,000. So that 60% is already collected by the time, because remember, they're asking us for November and December. So that's already gone. So in November, though, it will be the 40%. So 93,931 times 0.4. And I get 37,572.40. Again, I'm just going to drop the cents, the 40 cents on that. So we get 37,572. Now we're done with October sales, right? We collected in October, we collected in November, and we're done. So we're not going to collect any of that in December. Okay. Then we get to November sales. So we've got to go through some of this same process. So November sales were 150,000. Now, one of the things I could do, right, is I could just multiply this number, the 93,931, by 1.5 because it's 100,000, but I'll go through the math. So we will collect the 95% of that. And we get 142,500. Okay, we multiply that times 0.75. And we get 106,875. And multiply that times 0.015. Be a discount of 1,603. And again, the pennies I'm not going to worry about. Come back up here to the 142. 142,500. Subtract off the 1,603. That'll be 140,897. Okay, so that's how much that's how much of this 150,000 we're actually going to get to collect. Now this time I need the 60% because that's going to be collected in November. $84,538. So of November's credit sales, we will collect $84,538. And then we go back up here to the 140,897 and multiply it by 0.4, or you could just subtract the 84,538 from the 140. Either way you want to do that. And we get 56,359. Okay, so we're going to collect that in December. Okay, and now we come down to December sales. Well, we're not going to collect any of December sales in November, right? So we've got all of the November sales collected, or all the November collections budgeted, taken care of. But we do have to come back up here. We've got 90,000 times 0.95. And I think you can see why Excel would be your friend in something like this, where you've got repetitive tasks to do stuff like that. So we're going to collect or 85,500 of that 90,000 credit sales is collectible, but we multiply it by 75%. Will give us 64,125. We'll get the discount, and the discount will be $962. Oops. So we come back up here to the 85,500 that is collectible. Subtract off the 962. It's going to be 84,538 will be the total we collect out of that 90,000. And this time I only need the 0.6, right? Because they're not asking us for January. So, and that's going to be 50,723. Come back up here, 50,723. And I just add those up. So we will, something was wrong there. So I will collect 242,110 in November. And 187,082. All right. So that takes care of our cash collections for November and December. Then I want to calculate our cash disbursements for November and December. Some more paper here. And we are told that inventory purchases each month are 100% of the cost of the following month's projected sales. Okay, so and they're calculate the cash disbursements for November and December. Again, we're going to do the same thing, create a matrix, November and December, and we'll have October, November, and December here. Okay, so in October, let's see, inventory purchases each month of 100% of the cost of the following month's projected sales. Okay, so we have a So our inventory purchases are 270,000 for November. That's our sales. And we are told that the gross profit rate for Timco is approximately 30%. Okay, so what that means is that 270 is 130% of our cost, right? So we divide that by 1.3. So our purchases will be 207,692, and again, I'm rounding the decimal. In this case, it's 0.3, so I'm rounding it down. And then in December, that was our November. Let's see. We needed December sales. That's wrong. So December was 170. There we go. Divided by 1.3. Is going to be 130, 769. And then January, we are told that our budgeted total sales for January is 200,000. Is 153, 846. Okay. Well, actually, I did need the November because that's I wasn't wrong. All right. Okay. So we are also told all purchases are made on credit with 25% paid in the month of purchase, the remainder the following month. So we're going to pay 0.75 here. So of the October purchases paid in November, it will be the 155,769. Okay, so now we're going to pay, and that takes care of October. Now, November is the December sales, right? So it's 130,769. And we're going to pay for 25% of those in November, which will be 32,692 and 130,769, 98,077, round that up. And then the December, we're not going to pay for any of that in November. It'll be this one times 0.25, so 153,846 is 38,462. And now I just add those up. And I get 136,539. And here I get 188,488. So that's our answer for part 2. of that problem. Okay. One question that may come up is, why did I divide this by 1.3 as opposed to subtracting 30%? That's because my gross margin, the margin is 30% of sales, right? If I only took 30% of that, 270 or 70%, using that one for as an example, I would only be buying 189,000 as opposed to buying the total 207. So, where you take those percentages from does make a difference. So be careful whether you're talking about a markup, a gross margin, a profit percentage. So those are all have slightly different meanings, and you have to be aware of that. Okay, let's move on then to exercise 10-27. Cash disbursements budget. Bond company budgets the following purchases of direct materials for the first quarter of the year. January is 150, February is 120, March is 90,000. All purchases of direct material are made on credit. On average, the company pays for 80% of the purchases in the month of acquisition, and the remainder in the following month. Purchases take place fairly evenly throughout the month. For the months of February and March, what are the budgeted cash payments for purchases of direct materials? Okay, so 10-27, we want February and March. So again, we're going to set up our matrix with January, February, and March. So in January, our budgeted purchases were 150,000. On average, the company pays 80% in the month of purchase, and the remainder the following month. So we're going to pay 20% of that. That's going to be 30,000 in February. So 30,000 of February's payments get done in that. Okay, in February, we have 120. And 80% will be done in February. That will be 96,000. And 20%, or 24,000, will be paid for in March, and then in March we have 90,000, and we will pay for 90%, or sorry, 80% in March. That'll be 72,000. So 126 will be paid out in February. 96 will be paid out in March. Okay, then part 2 asks us the same thing. What are the budgeted cash payments for purchases of direct materials under the assumption that the purchase terms are 215 net 30? The company's policy is to take advantage of all cash discounts for early payment. Okay, so we're going to have the exact same thing here, right? Except we're going to take advantage of that. So we'll only pay 98% of each of those. So set up our matrix again: January, February, March. February, and March. This time we'll have 150,000 that's purchased in January, but now we get a 2% discount, so we'll actually only be paying 98%. So it'll be 147,000. And remember, we're only paying 20%. So we'll pay 29,400. Of course, we're done there. Then February, we've got the 120,000 in purchases, 98%. So that's going to be 117,600. And we'll pay 80% of that in February. So 94,080. And whoops. Having fat finger error trying to go too fast here. 117,600. And 20% of that. So we will pay for 23,520. That's a 4 there. And in March, we won't pay anything in February, but we're going to have the 90,000. And so 90,000 is 88,200, and we'll pay 80% of that. Will be 70,560. So 94,080. And 133,000. No, 123,000. That's right. Yep, 123,480. That's what we'll pay. Yeah, and we could have just taken 98% of that since it applies to everything. And number 3 says provide an economic argument why it may be good economic policy to take advantage of early payment discounts as required in Part 2. Well, this is one of the fun things that you can do. What's that 2% discount in actual annual rate? So you take 0.02 and you multiply that by 365 divided by 15. So that's going to be 0.48667, and that's simple interest. That's not even compounded. So you're actually, the annual interest rate on that is 48%. So that's a pretty significant savings. And again, that's simple. That's not even compounded. So, take it for what it's worth, right? Compounded would be approximately 61% interest on that. Okay. I think I've got two more wanted to do here. Number 31 is cash receipts and cash payments. We have information pertaining to Noski Corporation sales revenue is as follows. We've got the cash sales, credit sales, total sales. Management estimates 5% of credit sales to be uncollectible. Of collectible credit sales, 60% is collected in the month, and the remainder in the month following the month of sale. Purchases of inventory include 70% of next month's projected total sales stated at cost, plus 30% of projected sales for the current month stated at cost. All inventory purchases are on account. 25% is paid in the month of purchase. The remainder is paid the month following purchase. Purchase costs are approximately 60% of the selling price. So see, in this one, they're giving us a different metric, right? Before they gave us, it was a profit percentage of 30%. Now they're saying the sales price is, the purchase price is 60% of the selling price. Okay, and we want determined for Noski. Determined for Noski, part one, the budgeted cash collections December 21 from November 2021 credit sales. Okay, so this they're asking for something very narrow here. So the November credit sales are 240,000. 5% are uncollectible, so we will collect 95% of this. So we will collect 229,200 of this 240,000 sales. 60% are collected in the month of sale. So 60% of that was collected in November. And the remainder are collected in the month following the month of sale. So 40%. So 91,680 of November's credit sales will be collected in December. So that's part one. Then budgeted total cash receipts for January of 2022. Okay, so we're going to get in January, we're going to get the cash sales of 60,000. And we have credit sales of 180,000, of which 95% is collectible. So that'll be 171,000, but we collect 60% of that. So that'll be 102,600 January credit sales collections. And then we have December's credit sales collections. And that is going to be the credit sales in December is 360,000 times 0.95. $342,000, and we will only collect 40% of that, right? So that's 136,800 We add that up. Will be 299 400. So that's part B of number 31. And part 3 is budgeted total cash payments in December for inventory purchases. So now, purchases of inventory each month include 70% of next month's projected total sales. So we want December inventory purchases. So January is going to be 240,000 total sales times 0.7, right? That's how much we purchase. And the purchase costs are 60%, 0.6. So 240,000, 7 times 0.6 times will be 100,800. Okay, then we have the December purchases, and that's going to be, or sales is 460,000. But we only buy 30% in the month of sale. And again, our costs are 60%. So 460,000. That will be 82,800. We add that up. We get 183,600 is our total purchases in the month. All inventory is purchases are on account. 25% is paid in the month of purchase, and the remainder paid the following month. Okay, so this takes care of our December. We need 25% of that. So we get 45,900. Now we need to do the January purchases, and that's going to be January was 240. Plus, we need to do the December, or we need to do the November purchases. So that's going to be the 460. Get that right here. Okay, so we need the December payments. So we need the December purchases. 460 times 0.7 times 0.6 is going to be 193,200. And then we're also going to need the November, which is 320. Which will be 0.6 will be 57,600 plus 193, 200 is 250,800, but we're going to pay 75% of that in December. These are November purchases. And so that's not right. 250, 800 in there is 188, 100. Add these together. So that's the 45,900. We get 234 even. So that's going to be our part 3, the budgeted total cash payments in December for inventory purchases. All right. See, the last problem I have in this chapter set aside for you is the next one. 10-32, it's a retailer budget. D. Tomlinson Retail seeks your assistance in developing cash and other budget information for May, June, and July. The store expects to have the following balances at the end of April. Cash, $100,500. Accounts receivable, $437,000. Inventories, $309,400. And accounts payable, $133,055. Sales. All sales are on credit with terms 3/10 net 30, so that's a pretty healthy discount. Thompson bills customers on the last day of each month. The firm books receivables and gross amounts and collects 60% of the billings within the discount period, 25% by the end of the month, 9% by the end of the second month. The firm's experience suggests 6% is likely to be uncollectible and is written off at the end of the third month. All right. Now, first thing to notice on this problem, how they worded it is different than the others. On the others, they said 95% is collectible or 5% is uncollectible. Of the collectible, 60%. This one, they're telling you 60% of the total sales is collectible in 1 month, 25%, so that's 85%, 9% by the end of the second month. And so it's a little bit different, right? Just be aware of that. And then purchases and expenses. All purchases and expenses are on open account. The firm pays its payables over a 2-month period with 54% paid in the month of purchase. Each month's units of ending inventory should equal 30% of next month's cost of sales. The cost of each unit of inventory is $20. Selling and general administrative expenses, of which $2,000 is depreciation, equals 15% of current month's sales. Actual and projected sales are as follows. Okay, so we've got March, April, and May. That it says schedule showing budgeted merchandise purchases for May and June. Okay. Let's go back up here. All purchase expenses, the firm pays its payables over a 2-month period. Each month's units. The cost of each. The firm pays its payables over a 2-month period. Each month's units of ending inventory should equal 130% of next month's cost of sales. Oh, okay. So we've got the units here. Okay. So um, we're going to start with a production budget. I'm going to do it this way: March, April, May, June, July, and August. So here's our sales, and this is going to be in units, right? 11,800, 12,100, 11,900, 11,400, 12,000, and 12,200. All right. From there, we need the ending inventory. And it's going to be each month's units ending inventory should be equal to 130% of next month's cost of sales. Okay, so we can just do that. We need 130% of inventory, right, on this. So 12,100. Oops. We need 15,730 here. I'm just going to go across 11,900, 15,470, 14,820, 15,600, that's going to be 15,860. And of course, we lose the last month. Now, the reason I went all the way across, so I can just go down the ending inventory is next month's beginning. So we put the beginning inventory here, and of course, subtract it. So 15,730, 15,470, 14,820, and 15,600. So that's 260. So 12,260 there. And we're going to assume for March the 15, Okay. So now 11,800. We need to buy 12,190. All right, so now we have the units purchased. Okay, now each one of these we are told cost of each unit of inventory is $20. So we just multiply. Let's see, and we want for May and June. For May and June times 20. $225,000, and in June, $243,600. All right, so that's part one. Prepare a schedule showing the budgeted cash disbursements during June. Okay, so we go back up here. Our purchases and expenses. The firm pays payables over a 2-month period, 54% paid in the month of purchase. So in June, from May and June, we're going to have 225. So if 54% is paid in the month of purchase, 46% is paid from the previous month, right? So that 225,000 May purchases, 103,500 will be paid in June. Of the 243,600 purchases in June, 131,544. So that takes care of our the purchases part of that. And equals the selling and general administrative, of which 2,000 is depreciation, equals 15 months of current month sales, 15% of current month sales. So we're going to take the June sales of 342,000 times 15%. That's 51,300. But remember, depreciation is a non-cash expense. That's a little bit of a misnomer. At some point, you've got to pay the cash, right, to buy the machine. Now, whether you pay for it all up front, pay for it over time, there's just not a correlation of when you pay for it. But we consider depreciation a non-cash expense. It's part of capital budgeting. So we've got S&A of 51,300 minus 2,000. So that'll be 49,300. So that takes care of that. We add that all together. So that's part 2. Part 3 says prepare a schedule showing budgeted cash collections during May. Okay, so our cash collections, Tomlinson bills customers on the last day of each month. So May's collections are going to come from sales, coming from March, April, and accounts payable, right? Okay, so let's start off with the March sales. All purchases, let's see, sales. The firm books receivables at gross amounts and collects 60% of the billings within the discount period. So we don't have to worry about that with March. 25% by the end of the month, and 9% by the end of the second month. So March was, so that will be May, the end of the second. No, actually, yeah, 9% of May's sales will be, March's sales will be there. So 354,000 times 0.09 is 31,860 of March's sales will be collected in May. April sales. Okay, so April sales is 363,000, and they get a 60% would be 217,000, but they get a 3% discount, so we only get 97% of that. I'm going to come over here and put that 211,266. And we're also going to get the 25% of April, so 363 will be 90,750. And we add that together, we get 302,016 is in April. And then we have the accounts receivable. Okay, so we've got accounts receivable of 433,000. Yeah, those would all be written off. Those will all be collected or written off. So we just have the March and April. So our collections there. So 333,876 will be part 3, cash collection. And it says determine the gross and net balance of accounts receivable on May 31st. Okay, so the gross amounts receivable will be all the May sales, right? The 357. All of those will be accounts receivable. That's the gross amount. And then you will have 16% of the April. So that's the 9% you'll collect in May, on May 31st. So April, 9% of the April. So the 363. And so 9% they're collectible plus the 6% they're uncollectible is 15%. Is 54,450. Add that together. That's going to be will be 411,450. This is our gross. Okay, we'll take the 357 is 21,420, and we'll take the 363 is 21,780. Add those two together, 43,200. So 43,200. $368,250 is our net accounts receivable on that. So that number just comes right up there. All right, so that's the budgeting part of this. Good luck on your homework.